We're back now with some breaking news. Templeton's Mark Mobius says Korea tensions impacts on stocks may be short-lived. He says South Korea's outlook is positive. Well, my next guest says the rising tension between the Koreas could, in fact, create a buying opportunity in South Korean stocks. Manpreet Gill is the Asia strategist for Barclays Wealth. He's here visiting New York, and he added us onto his holiday schedule. Thank you, Manpreet, for coming in the studio. Good to meet you in person. You are based out of Singapore. So you have a sort of a closer look at what's going on in Asia right now. Let's start with South Korea. Many people are quite worried. We've seen a little bit of a sell-off in stocks there. I mean, the government did take measures to sort of stabilize what was happening in there, but it seemed as if it was just really a blip for them. It seems like things have stabilized, but you are not a buyer necessarily of the sovereign debt of South Korea, but you do like the equity markets.
We do like the equities because, we think valuations are still attractive. And if anything, the geopolitical tension is creating a good buying opportunity. We don't see the tensions as being, anything necessarily very different from other sort of similar events in the past. And, unless there's an outright escalation into something much worse, these kind of events have always been good buying opportunities. And, it's a market that's still, relatively inexpensive. It's close to about a standard deviation below its usual long-term levels. It's, leveraged to global growth. So if you have a positive view on economic growth, positive view on growth in the region, inexpensive valuations plus market weakness related around the geopolitical tensions creates a good buying opportunity in our view.
Let's now move, just broadly speaking, to the fixed income markets in Asia. Earlier this year, you had a buy recommendation. Back in April, you said it was a good time to go in to, it was China, Taiwan, South Korea. You liked their sovereign debt at the time. Yeah,
we really were focused on the local currency sovereign debt of pretty much most of Asia. I mean, as far as possible, we recommend taking exposure through any kind of managed product that provide exposure to regional local currency sovereign debt. We thought that the absolute yields were good. We thought there was a relatively underbought market, and we saw the a lot of long-term asset allocation shifts happening to the region. But as you noticed, we've actually closed out that trade because we think that was becoming an increasingly crowded trade, an increasingly popular trade. We saw a lot of the asset allocation shifts happening, but in specific markets like Indonesia, for example, a large part of the debt is now owned by foreign investors, and we just think that in case of any kind of reversal, some of these markets are looking a little overbought.
Are you suggesting now that clients actually sell that debt? You said you closed out those trades.
No, we've been recommending that clients hold on to their existing positions. We were just not comfortable adding more at current levels. Again, we think there's a solid long-term structural story. So again, if you look at markets like Indonesia, the Philippines, there's good reason to believe that many of these markets will get upgraded, over time. So over a long period of time, there is a positive story. The problem is more tactical when we've seen a lot of flows in 2010, so very popular trade.
Let's talk about China, because we have seen those bond markets do relatively well, certainly since the beginning of the year. But let's talk about China. Many people there now worried about inflation. The country is under pressure to sort of manage its currency relative to its trading partners. A lot of people talking about inflation, also a big concern for people living there. And we have seen some analysts earlier this month, in fact, there were some analysts from Goldman that actually said, sell your Hong Kong listed Chinese stocks. But your view now is that it's a good time to get into equities there.
Yeah, we still like Chinese equities, but I suppose important to point out that we actually prefer the onshore Chinese equities as opposed to the Hong Kong listed ones. Liquidity or tightening liquidity is sort of the key risk for an equity investor. And that's the ultimate risk you're taking if you're worried about inflation and the likely policy risk around, either CPI inflation or inflation in the housing market. That's definitely,
those two things are not of concern to you in their equity market.
They are of concern, but we just think that a large part of the liquidity tightening has already happened. If you look at a lot, new bank lending, you look at money supply growth, a lot of those indicators have come off quite dramatically from their peaks, coming straight out the recession 2008, 2009. So definitely liquidity tightening has been happening for quite some time.
And I know you don't recommend particular stocks, you're a strategist, but you do like certain sectors in these markets.
Absolutely. I mean, in China, we think financials are one sector that definitely look interesting. They've been sort of at the core of concerns in China, whether it's targeted measures which have been driven by policymakers impacted banks the most.
In Taiwan, you also like semiconductors, obviously. They're a big industry.
Definitely. But I think Taiwan has sort of been affected by more of a negative overhang or sort of a view on technology hardware in general. So that's part of the reason why valuations are so inexpensive. And just because everyone else simply dislikes the sector so much is a very good reason why we think it's time to start looking at it again. again, definitely at current valuation levels.
All right, Manpreet, thank you so much for joining us here in the U.S. Safe travels back to Singapore. We hope to catch up with you soon. That was Manpreet Gill, Asia strategist at Barclays Wealth.